This is Farouk from Actualize Digital Assets. I'm your host for today's live show. I'm thrilled to have you. Today, we're going to discuss tariffs, tech, and your investments. Let's get started. So, as usual, this is not financial advice, and all the recommendations that we give to you here are based on our best assessments. So, as I said, I'm really thrilled to welcome you, especially those of you with a keen eye on the global economic landscape. Today, we're tackling a topic that have been rattling markets and portfolios alike: the economy and tariffs. But don't worry, this won't be a dull show. We're here to explore what's really at stake for your investments with a perspective yet you won't find anywhere else. Grab your favorite hot chocolate or perhaps a glass of something stronger, settle in, and let's dive into the chaos and opportunity ahead. So let's imagine a scenario that could keep any investor up at night. Imagine waking up tomorrow to breaking news: China has invaded Taiwan. Forget the geopolitics for a moment. What does this mean for your portfolio? Taiwan produces over 60% of the world's semiconductors through TSMC alone. A conflict there doesn't just disrupt tech, it cripples global supply chains overnight. Switzerland, a nerve center for international trade and finance, along with Europe, would feel the shockwaves. Your holdings in tech, manufacturing, or anything tied to global markets could plummet. Now compare that to last week's tariff bombshell from Trump's administration. The S&P 500 tanked, markets worldwide followed. And yet, that was just a tremor compared to Taiwan crisis. Both scenarios expose the same truth. Our interconnected economy is fragile, and tariffs are poking at its weak spots. So how did we get here? And what can you do about it? Let's rewind the clock. Picture this: it's 1971, and President Nixon drops a bombshell. He ends in Bretton Woods system, unpegs the dollar from gold, and slaps a 10% import tax on everything. The Nixon shock was born. Economically, it was disaster, ushering a decade of inflation and pain. But here's the twist: it was a PR triumph. The Dow soared, the press cheered, and Nixon looked like a genius. Why? Because the crisis felt inevitable. Something had to give. Forward to today, Trump's Liberation Day tariffs have tanked markets and sparked chaos. The rollout is a mess. No one knows the end game. But here's my take: the market's reaction might be wrong again. Back then, the Nixon shock seemed bold because the system was breaking. Today, tariffs feel reckless because the system's still humming. Flawed, yes, but functional. For you, this is a reminder: don't just follow the herd. Market panic isn't always the full story. Now let's get into a bigger picture. For decades, the US has run massive trade deficits, especially with China. After World War II, America rebuilt Europe and Japan, pegging currencies to the dollar. Then came China with manufacturing that dwarfed the system's capacity. Their exports flooded the US. Their surpluses bought US debt, and the dollar stayed strong, defying logic. Here's the kicker: China's been deflationary force, keeping inflation at bay post Great Recession. But the cost: US manufacturing hollowed out, jobs vanished, capabilities eroded. Tariffs aim to reverse that. To force production back home: noble, maybe; feasible, maybe, but doubtful. China's dominance isn't just about cheap labor, it's about scale and expertise we've lost. For Swiss and European investors, this matters a lot. Your stakes in the global markets hinge on this shaky foundation. A China-Taiwan conflict, or even sustained tariffs, could unravel it all. No one wins in a trade war. but you can still position yourself to weather it. And now let's zoom in on tech. Where many of you have skin in the game, Apple's prime example. Steve Jobs dreamed of US manufacturing, but Tim Cook cracked the code in China. Why? Obviously, for scalability reasons. China delivers millions of iPhones with precision and speed the US cannot match. Tariffs threaten that. Higher cost means pricier iPhones, fewer sales, and the hit to Apple's service growth, the golden goose. It's not just Apple, Meta, Google, Amazon. They're all lean on Chinese hardware for gadgets and data centers. Tariffs are sent in their gears, but there is a twist. Software firms like Microsoft might dodge the worst. Bits don't get tariffed, atoms do. So if you're heavy in hardware stocks, think about pivoting to services. Diversification is not just smart, it's survival. It's truly about your survival. Last week's market meltdown wasn't irrational. Less trade hurts everyone: US multinationals, foreign firms, your portfolio. But here's where I zig when others zag. Chaos breeds opportunity. If e commerce slows, advertising might shift. App install ads could rebound, lifting certain tech niches. Meanwhile, Switzerland and Europe's stability gives you an edge. Consider this: diversify geographically, look beyond the US and China. Europe or emerging markets could hold steady. Lean into software, less tariff exposure, more growth potential. Hedge smartly. Gold or stronger Swiss franc could offset volatility. Spot the innovator. Startups solving supply chain woes could be your next big win. We've built your wealth with precision. Now it's time to protect it with creativity. So you can see here the market reaction have been just unbelievable over the last 5 days. It's the drops have been significant from up to 10 to 12%, and 13% for Nikkei. So where does this leaves us? Tariffs are a blunt tool, messy, risky, but not entirely misguided. A China Taiwan crisis would be worse, but even without it, the system's cranking. For you, my Swiss and European friends, this is a call to action. What step will you take to safeguard and grow your wealth and your portfolio in this shifting landscape? Drop your thoughts below. I'd love to hear them. Thank you for joining me today. The world's complex, but the right lens can help you master it. If this sparked something in you, hit like, subscribe, and until next time, stay sharp and stay curious. Thank you very much.